Welcome to Breaking News to Trading Moves. Today we're looking at something you see pretty often in markets, actually. A company reports really solid results.
Yeah, it looks great on paper.
Exactly. But then investors just hammered the stock anyway. The company in focus is Circle Internet Group, ticker CRCL.
It really is a classic setup, and, it tells us a lot about what investors are thinking right now. Circle's Q3 numbers were, well, very strong.
Revenue way up.
Sharply up, yeah.
Yeah.
And they beat earnings expectations. A big driver for that was the continued massive growth of their USDC stablecoin business.
Yeah.
Performance-wise, looked fantastic.
Okay, but despite that, the stock dropped, what was it, around 10%?
About that, yes. A pretty steep fall right after the announcement.
So for you listening, if a company beats expectations, it's growing fast, and the stock still falls. That usually means the market's got its eyes fixed firmly on the future.
That's it. Looking past the rearview mirror.
Focusing on, I guess, potential problems down the road. Structural risks.
That's the core analysis here. Investors basically ignored Q3 and jumped straight to two main worries. First, the big one. Concerns that falling interest rates are going to seriously squeeze the company's interest income.
Right. The money they make just by holding the reserves for USDC.
Exactly. You have to remember that interest they earn on the reserves, it's a huge chunk of their profit right now, and it's very high margin. Falling rates hit that directly.
Okay, that makes sense. And the second factor?
Higher guidance on operating spending. So yes, they're investing in growth, which is usually good, but investors looked at that combo, higher spending plus the potential loss of that easy interest income, and worried about margins getting squeezed badly.
So the market's essentially sending a message not just to Circle, but maybe to the whole fintech and crypto space.
I think so. The message is, look, if your profitability relies heavily on this high-rate environment, that might not last.
Okay, so if this reaction to Circle, good numbers, bad stock reaction is the benchmark now, what does that tell us about other companies in fintech, in crypto? Who else might be affected?
That's the mission, right? To figure out who might actually benefit if the market is bracing for lower rates and who's looking, well, vulnerable.
Using the CRCL reaction as a kind of test case.
Exactly. It's like a litmus test for how exposed different business models are to interest rate changes in the whole digital finance world.
All right, let's quickly recap the headline again just to ground ourselves. Circle's Q3. Pretty good, mostly thanks to USDC growing like wildfire.
Undeniably good performance numbers.
But can you quickly explain again for everyone listening, how exactly does Circle make that high-margin profit from the reserves, a profit everyone's now worried about?
Sure, it's down to how stablecoins like USDC work. When you buy, say, one USDC, you give Circle $1. Circle takes that dollar and puts it into reserved assets.
Mostly safe stuff, like government bonds.
Primarily short-term U.S. Treasury bills, yeah. Very safe, liquid assets. Now, in a high-rate world like we've had, where the Fed push rates up to 5% or even more,
that cash pile earns good interest.
A lot of interest. If Circle holds, say, $50 billion in reserves, and those reserves are earning 5%, well, you can do the math. That's billions in pretty much risk-free income for Circle.
Got it. Okay. So that income stream isn't really tied to how much USDC is being used for payments or trading.
Yeah.
It's purely about the Fed's interest rate.
Largely, yes. It's a function of the yield available on those safe assets.
So if the Fed cuts rates, let's say from 5% back down to 2%, Circle could lose, what, 60% of that easy profit almost overnight?
That's the math. That's the vulnerability the market suddenly decided to price in after the earnings call. It's not about adoption numbers. It's about the yield Circle gets on the adopted assets backing.
Makes sense.
Yeah.
Okay, let's flip it then. Let's look at who might actually benefit from this shift in focus. The potential winners, if the market really is anticipating lower rates.
Right. The common thread here has to be companies whose business models are just less dependent on earning interest from massive cash reserves.
So if your money comes from fees, from usage, you're better positioned.
That's the key difference the market seems to be making right now. You're more insulated from rate cuts.
Okay, first category here, card networks. Using stablecoins in payments.
Yeah, the thinking here is pretty straightforward. If Circle's own growth numbers show that USDC and maybe other stablecoins are getting used more widely.
Especially globally,
Yeah,
for things like cross-border payments.
exactly. If adoption is truly happening, then the big traditional card networks, the ones that have been working for years to integrate these digital assets, they stand to gain.
Because they get the benefit of more transactions without the risk tied to interest rates.
Precisely. Think about Visa, ticker V, and MasterCard, ticker MA. They make money from payment volume. More transactions, especially cross-border or B2B using stablecoins, means new fee streams for them.
And that fee is usually a percentage of the transaction, right? Doesn't matter if the reserves are earning 1% or 5%.
Correct. Their profit is tied to the activity on their payment rails, not the yield on the underlying funds being held somewhere. It's a cleaner model in a falling rate environment.
Okay, that makes sense. Second category seems to directly address the issue Circle highlighted. Transaction fee-focused fintechs.
This is where you really see the market drawing lines in the sand. Circle's stock drop basically put a spotlight on the risk for any company that makes a lot of money just from interest earned on customer cash balances.
So fintechs whose main income source is transaction fees or merchant fees, they look better now.
They're seen as having a much cleaner, maybe more durable model if rates do start heading lower.
No.
We need to separate earning interest on someone's idle cash versus taking a fee when they actually use or move their money.
Okay. The activity versus just holding.
That's the critical difference. Look at companies like Block, ticker SQ, or PayPal, ticker PYPL. They mostly make money when a merchant accepts a payment or when you send money to someone.
They take a small cut of the action.
Exactly. Now, sure, they might earn some interest on customer balances floating around, but the core of their high-margin business is driven by volume, by activity. If rates fall, their main revenue engine keeps running.
So they're winners because their business is built on movement, not yield.
That seems to be the market's read, yes. Their reliance is structural on activity.
All right, third category of potential beneficiaries. Fintech lenders that might prefer lower rates. This kind of flips the script, doesn't it?
It absolutely does. If the market sees the Circle reaction as another sign that rate cuts are coming, well, certain lenders actually like lower rates.
How so?
For them, lower rates mean their own cost of borrowing goes down. They need capital to lend out, right? If they can borrow that capital more cheaply.
It improves their margins on the loans they make?
Exactly. Lower funding costs boost their profitability on each loan. Plus, lower rates might also spur more consumer demand for loans, which helps their growth.
Okay, so who fits here?
Companies like Affirm, ticker AFRM, and SoFi Technologies, ticker SOFI, these growth-focused lenders often do better when they can get and deploy capital efficiently. For them, lower rates can actually improve the whole lending picture, unlike for the stablecoin issuers who rely on reserve yield.
Okay, so the dividing line seems pretty clear then. If you make money by holding cash and earning interest on it, falling rates are bad news.
Right.
But if you make money by moving cash, processing payments, or lending cash out, falling rates might actually be neutral or even good news.
That's a very concise way to put the market's current thinking, yeah.
All right, let's tackle the other side now. The potential areas of vulnerability, the losers in this scenario.
Okay.
This group would be the mirror image, right? Companies whose profits really swelled because of high rates, and now they face pressure if rates normalize.
And Circle stock drop is kind of the poster child, the warning sign for this whole group. So naturally, we start with stablecoin and reserve-driven crypto platforms.
Obviously, Circle itself is in this category, CRCL. Who else is seen as having similar exposure?
Well, the most prominent one usually mentioned here is Coinbase, ticker COIN.
Because they also deal with stablecoins and customer cash.
Yes. While Coinbase is a huge trading platform and makes a lot from transaction fees, a decent slice of their profit, especially the really high-margin stuff that isn't trading fees, comes from interest on customer cash balances and also the reserves for stablecoins they list and custody, like USDC itself.
So just like Circle, if rates fall, that part of their income shrinks, even if people keep trading Bitcoin.
That's the concern. That high-margin, non-trading revenue gets hit hard. Even if trading volumes stay strong, overall profitability could suffer. That's why CRCL and COIN often get talked about together regarding rate sensitivity.
Okay. Moving away from crypto specifically, let's look at traditional finance. Category 2. Brokerages that monetize idle cash. They had a fantastic couple of years, didn't they?
Oh, absolutely. They benefited massively from rising rates. Brokerages basically turned the cash that customers just leave sitting in their accounts, uninvested, into a major profit center.
How do they do that again?
They'd sweep that cash and invest it in very safe, high-yielding short-term assets like money market funds or T-bills. The difference, the spread between the high yield they earn, maybe 4 or 5%, and what they paid the customer on that cash, which was often close to zero.
That was almost pure profit for the brokerage.
Pretty much. A huge windfall. But if the market starts seriously thinking a whole cycle of rate cuts is coming,
That windfall dries up fast.
it diminishes significantly, yes. That tailwind just disappears. And this affects the big guys like Charles Schwab, ticker SCHW, but also the newer platforms like Robinhood, ticker HOOD. They use that interest income to help fund their growth.
Relying less on just trading commissions, which can be volatile.
Exactly. So losing that reliable interest income stream is a structural negative if rates fall.
Okay, final category of vulnerability. Online banks sensitive to net interest margin. Back to banking fundamentals here.
Yeah, this gets a little more into traditional banking, but it's the same underlying theme. The key metric is net interest margin, or NIM.
That's the spread, right?
Yeah.
Between what banks earn on loans and what they pay out on deposits.
Correct. It's the core profitability engine for most banks. Now, many digital banks and card-focused banks, they rely on maintaining a pretty wide spread to be profitable. The risk in a falling rate environment is that the yields they earn on their assets, like loans, tend to fall faster than they can lower the rates they pay on deposits to keep customers.
So the gap narrows, squeezing their margins.
That's the worry. The margin gets squeezed. It becomes harder to maintain that profitable spread. This could affect banks heavily reliant on this dynamic, maybe like Ally Financial, ticker ALLY, or Discover Financial, ticker DFS, which has both lending and deposit sides. The market's anticipating that wide spreads might be harder to come by going forward.
So looking back at everything we've discussed, it really feels like the main takeaway from this whole Circle situation isn't about Circle's current business health specifically.
No, the Q3 numbers were good.
Right. It's more about how the market is now intensely focused on separating companies based purely on how exposed their profit model is to future interest rate changes, even if current results look solid.
It's a laser focus on the source and sustainability of profits, not just the headline number. That high yield earned just by holding reserves. Investors are now treating that as potentially temporary, fragile income.
They're looking past transaction volumes, past user growth, and straight at the rate sensitivity.
Absolutely. That seems to be the dominant theme right now.
Okay, so as we wrap up, here's a final thought for you, the listener, to chew on. We've talked about how this focus on rate sensitivity is affecting fintechs, crypto firms, brokers, online banks.
The financial world, basically.
Right. But what about non-financial companies? Think about big tech firms, for example, that are sitting on huge piles of corporate cash on their balance sheets. If this high-yield environment really does fade away, how might that impact their earnings reports, which have also benefited from higher interest income recently?
That's a really good question. A potential knock-on effect to watch.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.